Can you turn $100,000 into $5,000 a month? Yes, you can, and I'll show you how. If you want smarter cash flow strategies, hit like and subscribe.
Welcome to this explainer. Today, we're breaking down a highly detailed recipe for turning a standard investment into a massive passive income engine. We're talking about a very specific, carefully engineered 10 ETF strategy designed specifically for the 2026 market landscape. Okay, let's dive right in. We're going to start with a realistic, but definitely substantial, initial capital investment of $100,000. We really need a clear starting line to see exactly how the math works, and $100,000 provides the perfect baseline to show off the true power of compounding high-yield assets. And this brings us to the ultimate goal. We are transforming that initial sum into a $5,000 per month income stream in just a few short years. Yeah, that's $60,000 of annualized passive income. It sounds super ambitious, I know, but as we're about to see in the source data, it's really just a matter of strict mechanical execution. No magic involved here. Section 1. The hybrid engine and its 70-30 split. To bridge that massive gap between our starting capital and our target income, we absolutely need a specific architectural framework. It's not just a random assortment of stocks. Our engine relies on a really precise 70-30 split. We're allocating 70% to high-yield weekly funds for pure horsepower and the remaining 30% to monthly funds for vital stabilization. Honestly, this balance is the entire secret to making the strategy sustainable. Think of it like building a high-performance vehicle. If the weekly ETFs are the cylinders driving massive 35 to 45% yields, the monthly ETFs are your shock absorbers. They offer a much lower 8 to 14% yield, sure, but their job is smoothing out the ride and protecting your underlying principal. Moving on to Section 2, the component parts, looking at the cylinders and shock absorbers. Let's look under the hood to see the exact funds that make up this 2026 edition portfolio. Okay, so these 7 weekly ETFs are your primary income engines. They lean heavily on the underlying strength of massive tech and crypto-linked assets. We're talking NVIDIA, Apple, and MicroStrategy. And the reason this actually works is that the upward momentum of these specific underlying stocks helps offset the call drag that you'd typically associate with massive 30 to 40+% yields. They provide that aggressive cash flow we really need. But, there's a catch. High yield often comes with a hidden cost called NAV decay. Basically, this is the gradual loss of a fund's net asset value over time. So the absolute crucial point here is that to prevent NAV decay from eating away at your initial $100,000, we must include our stabilizers. Without them, your principal shrinks and, well, eventually so does your income. Enter the shock absorbers. These 3 end-of-month payers, JEPQ, SPYI, and Devo, provide significantly lower yields, but they completely anchor the portfolio. They step in with steady dividend growth, positive price trends, and that vital capital preservation, keeping the whole 10 ETF structure fundamentally sound. When you blend these volatile, massive yielders like NVDI pushing 40% with conservative monthly anchors like JPQ sitting closer to 11%, you get a perfectly balanced machine. It's the best of both worlds, aggressive cash flow generation and rock-solid structural stability. Section 3, the compounding simulation. Now that our engine is fully built and we understand the parts, let's run the numbers and look at the actual math that gets us to a consistent $5,000 a month. By weighting our 70-30 split, so calculating 70% of the portfolio at roughly a 40% yield and 30% at a 12% yield, the effective annual yield of this entire setup lands at an incredible 31.6%. That right there is the baseline growth rate we're working with. But listen closely, because this is absolutely crucial. This strategy only works if you use full drip. That stands for dividend reinvestment plan. During the build phase, you are not touching a dime of this income. You're reinvesting every single penny back into the machine to purchase additional shares, massively accelerating your growth curve. With that drip turned on, that 31% annual yield translates to roughly 2.33% of portfolio growth every single month. It might sound like kind of a small number on a monthly basis, but when it compounds relentlessly, the results are completely staggering. Just look at the math in action. Starting at month 0 with $100,000, the compounding effect takes hold fast. You crossed $132,000 by year 1 and blast right past $150,000 right around month 18. The snowball literally gets bigger and faster with every passing month. So what's the magic number we're actually aiming for on this curve? Well, because our blended yield fluctuates safely between 35 and 40% in the source model, you need your total portfolio value to hit exactly $171,428. Once you reach that specific balance, a 35% yield safely and consistently generates your goal of $5,000 in monthly income. Section 4, Timeline to 5,000. So, the ultimate question is, how long does it actually take for this compounding machine to hit that target so you can finally switch off the drip? Depending on market conditions, particularly the underlying strength of NVIDIA, the broader tech sector, and Bitcoin proxies, the source outlines a very realistic range. In a best-case scenario with strong tech performance, you hit the goal in just 2 years. A base case puts you at 2.5 years. And even in a totally conservative scenario where we account for some stubborn NAV decay, you're still looking at just 3.4 years to build a $60,000 a year passive income stream. Section 5, your weekly payout calendar. Okay, let's dive into what your actual calendar looks like when the portfolio is fully operational and you finally turn off that drip. Because these weekly funds are strategically chosen to rotate their distributions, you receive income every single week. It's awesome. In week 1, you get paid by your NVIDIA and Palantir cylinders. Week 2, your Apple stability anchors drop cash. Week 3 brings MicroStrategy and semiconductor yields. Week 4 drops cash from funds like TLPW and QQQY. And finally, the end of the month delivers a massive stabilizing boost from your monthly shock absorbers. It is just a constant flow of capital. By engineering your capital this way, you turn abstract percentages into a relentless, scheduled stream of cash. You aren't sitting around waiting for quarterly dividends and just hoping for the best. You're effectively acting as your own high-frequency bank, collecting premiums week after week, month after month. After seeing the math behind this hybrid weekly and monthly drip engine and watching exactly how an initial investment can compound into a massive income stream in under 3.5 years, you have to stop and ask yourself, looking at your own strategy right now, is your portfolio working this hard for you every single week?
Thank you for staying to the end. If you haven't yet, please give me a like and subscribe. It means the world to me and helps me make more videos. Thank you so much. Goodbye.